Right, now in the previous chapter we had a look to see where we get our finance from, and what we're going to do in this chapter is have a look and see what that finance is actually costing us. And by the end of the chapter we'll know what the cost of capital of the company is, which we could then use in chapter D for our investment appraisal, because we needed a cost of capital, a discount factor, to use for our investment appraisal. So this starts to wrap the whole thing up. And the first thing we're asked to look at is the relationship between risk and return. And with a company, it has two different types, as we've said, of finance, mainly, which is equity finance and debt finance. And the equity finance, as we mentioned already, is the primary risk, which means it takes the main risk. And because of that, it's high risk, and so it would also want to be paid a high return in the long term. Debt is lower risk because the loan is often secured on the company's assets and it's paid before the shareholders, and so the returns on debt would be lower because the risk is lower. So there's a link always between risk and return. When the risk is higher, you'd want on average a higher return. When the risk is lower, you'd want on average a lower return. And the return and the cost are directly linked. So a high return means a high cost, a low return means a low cost. And then just finally, before we finish this section, as you may remember from chapter D, we mentioned that if you bring tax in to the calculation, that actually makes the debt even cheaper. And so the cost of the debt is low because it's low risk, but it's also low because of the tax saving when we make interest payments. Now, all of this will come up later in the chapter, so this is just setting the scene for us for now. Section B asks us to look at the creditor hierarchy, and the creditor hierarchy is simply the order your creditors, the people that have invested money in you, are paid, especially if a company gets into difficulty. So first of all, we have to pay what are described as the secured creditors, and a secured creditor is anybody who has security over your non-current assets in the form of a fixed charge. So the charge is fixed on particular assets. So if you have a mortgage to buy a flat or a house or whatever, the mortgage company are a secured creditor. They have a fixed charge on your property. We then have preferential creditors, people who take preference over other creditors, and that includes the pension scheme and employees. So if a company was to get into difficulty, they have to pay the staff salaries and so on, though in the UK there's a financial limit on that, but preferential creditors. You've then got floating charge creditors or holders, and a floating charge is where the charge isn't over a particular asset, it's over a type of asset. So for example, you may have a creditor may have a floating charge over your stock, and their loan or whatever they've given you is not fixed to individual items of stock, it's to all of your stock. And you can sell some stock and buy some more stock, and that doesn't change anything. They've got security over your stock, so they come third. You've then got unsecured creditors, so that people like your normal payables or the Crown in the form of the taxman. You've then got, if you have them, preferential shareholders, the preference shareholders, and then last of all, the ordinary shareholders. Now, what we were just looking at the section A of this the syllabus, we were saying at one end we've got the debt, and the debt is basically your secured creditors, because debt tends to be secured, and at the other end you've got your ordinary shareholders. So we really, in part A, looked at 1 and 6, and so you can plainly see that there is a lot more risk being an ordinary shareholder than there is being a debt holder. And so more risk, as we said, means you would want on average more return, and more return, as we said, means more cost. So before doing any calculations at all, I would expect the cost of equity, because it's a higher risk, I would expect the cost of equity to be higher than the cost of debt. Now, what we're now going to do is to have a look and see how we work out the cost of equity. So section 2 introduces us to working out the cost of equity. And the first approach we're going to use is by looking at the dividend growth model and use that to work out the cost of equity. And the dividend growth model is given to us in the exam, and so we've got a formula here that we can use, and what we'll do is have a look where that formula is on the formula sheet as we've done before. So if we just pop back to the formula sheet, and if you go about to the middle of the first page of the formula sheet, you'll see there we have the growth model, and there is the formula. And as with other formula on this page, the formula is given, but it doesn't tell us what the individual symbols stand for. So we need to know what these different letters all stand for. So if we just go back for a moment to the notes and go over the page, we can find the symbols here, and P0 stands for the P price of the shares at time naught today. And what is more, that price must exclude any current dividends. So if the company is about to pay a dividend of, say, 10 cents, then you want the share price excluding that 10 cents dividend, so you just have to take 10 cents off the share price to get it as an ex-div share price. We've then got D0. D stands for dividend, again to at time naught, so that's the current dividend. We've got G, which is the constant growth, G for growth, in the dividends, and this model does assume that your dividends are going up by the same percentage every year, and G would give you that percentage. And then RE, which is the return on the equity, or if you prefer, the cost of the equity. And so that is in fact what we would be looking to work out. We want to know what is RE. And if you just go back for a second to the formula, you'll notice that actually the formula starts not with RE, it starts with P0. So it's got RE in it, but it doesn't start with RE. So this formula doesn't appear to be quite right for us, and that's because strictly this formula is being given to us for us to use in the next chapter, not this chapter. So we'll come back to this formula. But what we can do is we can rearrange this formula to get the formula that we need for this chapter. And we can do that, first of all, by swapping the top and bottom. So in other words, RE minus G, which was on the bottom on the right-hand side, would equal D0 times 1 plus G divided by P0, and the P0 was on the top on the left-hand side. So I've just swapped those two round. And then what we need to do is to get rid of the minus G on this side, and so we can do that by adding G to both sides. So plus G to both sides, those G's then cancel out, and so that leaves me with RE equals D0 times 1 plus G over P0 plus G. And that's where I've got the formula from on the next page. I've just rearranged the formula that's on the formula sheet. And if you are happy to rearrange the formula, then that means you don't need to learn this formula. If you don't like the maths of rearranging it, then this is one that you will need to learn. But I say just you need to make a decision on which approach you'd like to take there. Now, the important thing is that we can use the formula. So here's an example to make sure you're happy with what's going on here. And we're told that Lane & Co has just paid a dividend of 25 cents on its ordinary shares. Just paid, so that must be the current dividend is 25 cents on its ordinary shares, which have a market value of 3.75. Now, if it's just paid the dividend and you were to buy the shares, you will have missed that dividend because it's just been paid. So that 3.75 must be the price excluding the current dividend, which is exactly what we wanted. We said P0 was the ex-div price. The constant dividend growth rate, it's constant, which is important for this formula, is 9%. And what is the cost of equity for Lane & Co? So we need to identify the ingredients in the formula, and the formula starts with D0, and D0 is the current dividend, and we were told that is 25 cents. We also need G, and that is the constant growth rate, and that's 9%. But as with previous formulas, we must put that in as a decimal, so that's actually 0.09. And P0 is the price, XDiv. Now, we've already said the 375 is the price, XDiv, but we need to be careful. I've just written down the dividend in cents, so I need to write the price, the 375, in cents. If I was to use $3.75, that's fine, but my dividend would then need to be $0.25. It doesn't matter which you do, as long as you are consistent. So they must both be in cents or both be in dollars. It doesn't matter which. And we can then work out, using our formula, RE. RE is the dividend, so let's do this in dollars, 0.25, multiplied by 1 plus the growth rate, 0.09, so in other words 0.25 times 1.09, divided by the 375, and you need to work that out first, and then once you've worked that out, plus the G, plus the 0.09. And that comes out, if you have a go at that on your calculator, at 0.16 or 16%. Now, the only problem with this approach is it does assume that, as we said, companies are going to pay a constantly growing dividend, and generally speaking, that is not the case in practice. So this won't work unless you've got a constant dividend, and I say that's unlikely. And also, in practice, getting the ex-div share price is much harder than it will be in exam questions, because it won't necessarily be a couple of days since you paid the dividend. It may be several months since you paid a dividend, and the next dividend may be due in 3 months' time. How do you work out the share price today then, excluding that dividend? Because people will know that dividend is coming, so they'll be starting to factor that into the current share price. So that's going to be difficult. The constant dividend is unlikely, and getting the ex-div share price at times will be difficult. It won't be in the exam for us, but at times in the real world will be difficult. Now, we have got a second approach for working out the cost of equity, and this involves a formula known as the capital asset pricing model, which is far too much for us to remember, so we abbreviate that to CAPM, C-A-P-M, CAPM, and the CAPM formula is also given to us on the formula sheet, so let's have a look at that one on the formula sheet, and that one is just above the growth model, and it's titled the capital asset pricing model, so it's a good clue there, and there's the formula, but again, this formula doesn't define the different elements that are being used in it. So let's go back to our notes and define the different terms. And the first term, E bracket RI, looks a little bit of a bundle. The E stands for expected, and that's the expected using probabilities that we talked about earlier in the paper. So strictly speaking, this is the long run average. R, return, and then I on an investment I. In other words, for us, this is the cost of equity of company I. So this is what we're trying to work out. This is the cost of equity. So a different symbol to the cost of equity used in the dividend growth model, where we said the cost of equity was RE. So the symbol RE, standing for cost of equity, we're now using the symbol E of RI. So it is a little bit annoying that we're using a different symbol for the same thing, but that's just what we're given on the formula sheet. So that's what we're going to be working out, and to work that out we need capital RF, which stands for the risk-free rate of return. So if investors could invest their money with absolutely no risk whatsoever, what return would they get? And obviously it'd be quite a low return, but that's our starting point, that's RF. We've then got beta I, and beta measures the amount of risk that we're facing, and it actually measures the amount of systematic risk, and I'll come back to that one over the page in just a second to explain exactly what that means. We've then got E of RM, and E of RM is E for expected again, so the long run average, return for R on the market M. And because the stock market has more risk than risk-free investments, I would expect E of RM to be a higher number than RF. And indeed, we take off RF at the end, as you'll see, because what we're working out in that bracket is what's called the equity risk premium. How much more return is being paid by the market because the equity market has more risk. And so we're saying that the cost of equity will be the risk-free cost plus an extra bundle. And this bit here will work out the extra bundle for us. As we can see, that depends on the expected return from the market and the risk-free return, but it also depends on this beta factor. So it is important, though the number will be given to you in the question, it is important that we understand what this beta is all about, and I've explained that on the next page. So let's go and have a look and see what we've got to say here. The capital asset pricing model assumes that what you've done is you have what's called diversified your portfolio. So in other words, you haven't put all your eggs in one basket, if you've ever come across that phrase. And if I was going to collect the eggs from my chickens and I put them all in one basket and I dropped the basket, I would lose all my eggs. All the eggs would be broken. If I put the eggs in lots of different baskets and I dropped one basket, I'd lose the eggs in that basket, but all the other eggs would be safe. And this is the idea of investing your money. If you invest all your money in one company and that company gets into difficulty, you lose everything. Whereas if you invest your money in lots of different companies, and one gets into difficulty, that doesn't matter as much. And so this is the basic idea behind the capital asset pricing model. And if you imagine for a moment that I had two different companies that were competing with each other, and I invested my money in both of those companies, and let's just say that one of them then has a strike. So obviously the company with the strike loses its production, loses its sales, and does badly. But the other company it's competing with, who doesn't have the strike, will benefit because it will get all the sales that the first company is losing. Now, the total sales won't be any different. In total, the sales will be the same, but it's just the split of those sales between those two companies. Now, if I diversified and had money in both companies, the strike wouldn't matter. Whereas if I'd left my money in just one company, the strike would matter. And diversification gets rid of those strike-type factors, and we call those unsystematic factors. However, if the economy in which those two companies were operating was to go into recession, they would both suffer, and diversifying won't save me from that problem. So this is described as a systematic risk because it's a risk that's in the entire system. And the beta factor that we're using in our CAPM formula measures the systematic risk. And if you think about it for a moment, if the economy goes into recession, people like the supermarkets won't suffer that much. We still need to buy food. Indeed, perhaps if we're not going out to eat in restaurants and so on, we might buy more food. So the supermarkets won't really suffer in recession. Having said that, if the economy then goes into boom, neither are they going to benefit that much. So their beta factor would be relatively low. If you were a luxury holiday company and the economy went into recession, I can imagine your sales would nosedive. But having said that, if the country went into a boom, your sales would presumably go through the roof. So a holiday company, a luxury company, something like that, would have a much higher beta. A supermarket would have a much lower beta. And the betas aren't measured as a percentage, they're measured as a number. And the whole market as a whole has a beta factor of 1. So if you like, that's your average. So if your beta is above 1, you've got more risk than the average. You're the holiday company. And if you've got a beta of less than 1, you're the supermarket. You've got a lower risk than average. And the beta, I say, shows us how much systematic risk there is. And the more systematic risk there is, the more risk that the shareholders face, so the more return the shareholders will be looking for. And I've just described down the bottom here the capital asset pricing model in words rather than in formula. So the return that's required by the shareholders is the risk-free return, because they can always get that, plus an extra dollop because of the risk that they are taking. And so just to show you how this works, if we have a look at example 2, because the examiner has to give you all the information in the question, this is relatively straightforward. And we've got Drew Boy Co. has a beta value of 1.5. The average return on the market is currently 17%, and the risk-free investments are paying a return of 5%. What is the cost of equity for Drew Boy Co.? So if we just go through, we need to know what RF is to use the formula, the risk-free rate, and we're told that that is 5%, so 0.05. We need to know the beta of the investment, beta I, in the formula, and we're told in this question the beta is 1.5. That's not 1.5%, that's just 1.5. And we need to know the expected return on the market to use the formula, and that is 17%, so 0.17. And so we can now put those figures into our CAPM formula. So the expected return from investment I is going to be 0.05, the risk-free rate, plus beta 1.5 times the market return 0.17 minus the risk-free rate 0.05. And for the maths, you have to work out the figure in the bracket first. So what is 0.17 minus 0.05? So that's 0.12. You then multiply that by the 1.5 next. So what you've now got is 0.05 plus, and in effect, 1.5 times 0.12. So that's 0.05 plus 1.5 times 0.12 is 0.18. And so we've then got 0.05 plus 0.18, and so that comes out at 0.23, or, if you prefer, 23%. Just so you know, in this particular formula, I could have put the percentages in as percentages. I could have put in 5 and 17. However, I don't all the formula all the way through the exam. I put in as decimals because it just gives me a much simpler approach. So just one rule all the way through. And then at the bottom, we just need to explain the advantages and disadvantages of the capital asset pricing model. The advantages are that, first of all, it links the risk and return directly. As the beta goes up, as there is more risk, the return will go up. The answer we get is higher, or if the risk goes down, the return goes down. So there's a direct link between risk and return, which is useful to us. Also, if the dividends are not growing constantly, as we said with the dividend growth model, they may not be, that doesn't matter to CAPM. You can still work out the cost of equity. The problem with the CAPM model is, though, it only works if the investors have diversified, and that might be true on the stock market, but it wouldn't necessarily be true of private investors who've got all their money in just one business, one family company or whatever. So that won't always be the case. We're also assuming that the risk-free rate and the market return and the beta will all be constant all the way through the time we're using it, and those figures tend to be taken from historic data, so we're assuming that will also be appropriate, and that may not be the case. It may not remain constant, and it may also be the case that the historic figures change. Also, in order to prove this theory and this model, I mean, you don't have to do this in the exam, but the assumption is that if you invest money or borrow money, the interest rate will be the same, and we know in practice that's not the case. If you invest money, you get a lower rate of return than you do if you borrow money, so that's a problem as well. And then also it assumes that the capital markets are perfect, so we don't have to pay transaction costs when we buy and sell shares, we don't have to pay tax, etc. And again, in practice, the capital markets tend not to be perfect. So it does have its problems, but having said that, capital asset pricing model is a model that's actually used out there in the real world.